Markets are more interested on what central banks are going to do than on geopolitical risks. And this makes sense because historically, geopolitical risks have created very small bumps in markets and been washed out of concerns from investors very, very quickly. However, this time, it may be that market participants are way too optimistic about everything that has to do with monetary policy, as well as very optimistic about the outcome of geopolitical risks. On the outcome of geopolitical risks, it is pretty evident that market participants seem to be happy about expectations of weak growth, but growth in the global economy, and a significant slowdown in the inflationary burst that, however, continues to be persistent. So there is optimism about growth, optimism about inflation, but interestingly enough, with it, very high optimism about the central bank process and whether central banks are going to cut rates. Because if people are so optimistic about inflation and growth, then why should central banks cut rates as the consensus expects? And certainly why implement any type of expansionary policy? It doesn't compute. To add to it, if geopolitical risks are not going to create bumps in the economy, then central banks are likely to be more hawkish than dovish. But if those geopolitical risks create a slowdown in the economy that is weaker than what consensus currently has in estimates, the likelihood of central banks to continue to implement expansionary policies as in the past is very, very low. It is very difficult to believe that we are going to see giant QEs and negative real rates in the near future, whatever happens, both on the fiscal side and on the geopolitical side.